A very good afternoon. For those that are joining this Rand Swiss webinar on small to mid caps, welcome. For those that don't know me, my name is Anthony Clark. I'm Small Talk Daily. I'm coming live to you right now from a small little dorpie in the Swartland in Cape Town called Korenberg, where I'm actually working away. The dog is running around the house that I've Airbnb'd for a week and a bit. And this diary date has been in my schedule for quite some time, and there's no way I would ever miss a presentation that I've committed to with Gary and Pascal at Rand Swiss. So initially, from me, a very happy new year to you all. I hope it's a prosperous and healthy and hopefully electrifying one in more ways than one. And then a shout out to Gary, all the team at Rand Swiss, and of course, Pascal for organizing this and for asking me to do this webinar. I hope it's going to be instructive and you come away with a few tidbits. I'm hoping it'll last about an hour. There is a Q&A chat here, but I know that Pascal is staying on the line because I'm not very good with technology, for those of you that know me well. I've also have a little bit of gastro. So if you see me sipping on my Energade or Powerade, you know why. And of course, my throat. But otherwise, we're going to crack off. Firstly, I'm going to give you a quick précis of what happened last year in my top 5 stocks. It started the year extremely well. At one point by the mid-2022 period, the portfolio was up just over 20% when the small cap index was down about 10. And then suddenly in the second half, the wheels fell off the bus with a de-risking of Renogen and problems with its operations in the Free State, drawing the ire of investors, and that saw significant sell-off. So at one point, Renogen, which was one of my top 5, was up 29%. It ended the year down at 29%. And just as a side tidbit, I'm led to believe that the errant module that caused the helium system to actually stop producing arrived in Johannesburg last Wednesday. It was then driven down to the Free State and then installed overnight. And we're now pre-testing the module and the cooling box, taking it down to 240 degrees. It has to get down to about 280 to get helium. So I would hope that in the next week or so, a long-awaited announcement from Renogen is coming regarding helium. We are producing LNG, and that's going to ceramic industries, part of Italtile, and of course, Consol Glass. The other stock that did fantastically well for me last year, if Renogen was my counter, was Sabcap. That was up from memory 44%, including dividends. That's the investment company run by very well-known entrepreneur Christopher Seabrook, who I've known for 25 years. And in the year, a combination of a reopening of the global economies, particularly to some of his international interests, and some new investments and revaluations, saw that stock and its net asset value soar. I had a very aggressive target for net asset value and for the share price, and they were all attained. I haven't checked the price since the close earlier, excuse me. But at about 84, 85 Rand, it's certainly a stock that I own in my portfolio, and I would absolutely never sell it. If you want to get exposure to a basket of small to mid caps, mainly in the private equity and unlisted space, involved in a number of very exciting areas of the economy, one of the few ways that we as a private client investor can get in is Sabcap. So even at the current levels, the discounts about 20% to NAV, I'd still recommend the stock for any long-term portfolio. The other stock that didn't do that well for me last year was Sizwe, the small platinum company. In fact, it started the year off gangbusters. At one point, it was up over 60%. And again, as the year progressed and the deleveraging of interest in commodities, and particularly PGMs, occurred, and there was a revolving door of Chinese CEOs and problems with the mine with a strike and other operational issues, the share price completely slumped. So I ended the year basically break even on that. So in aggregate, my top 5 last year returned just over 5.3%, which doesn't sound great shakes, but you didn't lose money. If you'd been in the wider market last year, you would have actually lost money. Only the small cap index clawed in an underlying return for the entire year of 1.4%. What basically happened in the last quarter of the last year is, as the Dow Jones from September had a huge rally, that dragged international markets with it, particularly the large cap stocks in the Aussie. So the Aussie at one point was down about 15%, and it basically ended the year down about 2 or 3%. And the small to mid caps basically were not in favor, so they stayed static. So what do I expect for this year? This year is a very interesting one. All of you know that we have gone through a very aggressive period of load shedding. I'm sure you've seen and read many of the comments from many of the listed businesses about the impact of load shedding onto their underlying operations and potential revenue and profitability. But for all of that, there's always opportunity. I always look on the bright side of life. It's always darkest before the dawn. Excuse the pun, that wasn't an ESCOM joke. It's just an old English saying. So this year, when I was selecting my stocks, which were actually done on the 21st of December, I'd worked on this pretty much throughout most of December, because I tend to work on my desk when most of you are sitting in Plet or basking in the sun, because I like to keep on top of things. And I was going for a far more defensive type portfolio with companies which are well known, which have fairly resilient business models, and hopefully should be able to withstand the slings and arrows of the economy and, of course, what's going on inside varying SOEs. So I chose a combination of some very well-known small caps, some very well-known mid caps, some special situations, 2 stocks from a Cape Town Stock Exchange, because I think that Cape Town Stock Exchange, despite being small, has some very interesting counters listed and needs promoting. And then lastly, my wild card. So being as none of you here can actually chat to me, I am going to be starting off with my wild card. The wild card is Nampak. The reason I chose Nampak will unfold in the next few minutes. There was a meeting this morning for shareholders, which I participated in at 9 a.m. And it was a strange legal meeting. Basically, it was a meeting to postpone a meeting. Those of you that have been following the story know that Nampak is heavily indebted, is one of Africa's largest packaging companies, and most of its products are things that we use on a daily basis. Whether you open a can of Coca-Cola, a can of beer, or even a can of tinned food, it's predominantly made by Nampak. So Nampak currently, despite being saddled by debt, is actually doing okay, thank you. But the scope of the debt and the size of the debt has really concerned the market and concerned management, to the point they had to go cap in hand a few weeks ago and beg the market to potentially support a 2 billion rand rights issue. Now, the reason why that caused the share price to completely slam was that Nampak's one-time Aussie 40 rating slipped. The last time I checked, its market value was below 600 million rand. In fact, Bowler Metcalfe, a small packaging company I've covered for the best part of 30 years, was larger than the giant Nampak, purely because of its debt situation. So what did the meeting this morning actually do? What happened over the festive period, perhaps unbeknown to many of you, and I did say I'd give a few tidbits on this webinar, which were not in my notes, which I'm hoping you've seen via the Rand Swiss platform or my platforms, is that an activist shareholder and a group of very large shareholders got together to form what I would call a voting bloc. I coined the term cabal, which is just basically a collection of like-minded people looking to do the same aim. They hold about 40% of Nampak, and they basically told the board that we will not vote on a rights issue because it's highly dilutive, and we believe there are many other stratagems that you can actually undertake. One, to refinance the debt and try and get some of the errant banks internationally off your back. 2, sell assets, either domestically or in Africa. And 3, improve your working capital position, which would negate a substantial rights issue. It seems like the activists are only happy to have a rights issue between 500 and 750 million. With the cancellation of a meeting last week, that led the market to rally Nampak. As I checked this morning, Nampak year to date is up about 27%. So it's had a very good start to my wild card portfolio. Now, what do I think is going to happen? Well, from this morning's meeting, it is clear that management now know that the activists are intent on significant change and will not be pushed around. So management indicated from a week Friday, they'll be issuing quarterly updates on the progress of the refinancing and the operational status of Nampak. Then on March the 8th, they'll have another meeting to try and lay out to the activists and the large shareholders what their plan of action will be. And then that will be voted upon. So excuse me. So I'm hoping in the next, call it 2 months, that the company, the bankers, and the large shareholders get together, bang a few heads, they all chip something into the party, and Nampak negates a very large rights issue, which could cause the share price, in theory, as I touched some wood here, I'm sitting at a wooden table, to actually run quite hard. Because if you look at Nampak itself, despite the large debt pile, the company has not broken any of its banking covenants for its debt. It continues to be fairly profitable. It's just that a combination of past management mistakes and mistakes by the current management led to the current mess we are currently in. As an example, the current management decided, for their infinite wisdom, rather than bring the money trapped in Nigeria back to this country, they'd leave it in Naira, just as the Naira completely collapsed in value, costing you, the shareholder, 800 million rand. That was easily avoidable. So I think going forward, management perhaps will be a little bit more cautious with our money. Perhaps there'll be new management in place post restructuring. And I believe that Nampak, as it stands right now, is a classic wildcard. We have a business probably worth, in a breakup situation, north of 6 Rand a share. And if you can just improve its working capital and its debt situation, the share price at the last time I saw it was about 135. I think could be a lot higher. I've got a target value for the stock, if all pans out, of 3.50 Rand. Now that may seem very, very high. Excuse me again. But let's not forget that this company actually has potential. And as I detailed this morning in an interview to Business Day, the best stories are often the simplest. If you are the largest supplier of tinned cans in terms of beverages and food in Southern Africa, and you go belly up, you're not going to get all of these products on the shelves, which means the like of an AB InBev, Coca-Cola, Rhodes Foods, Koo brands, etc., will have no packaging. So there could be calamity in the domestic food market. So I think something will be done to save this company, to restructure it, and as such, turn the company around. So I'm prepared to have a bit of a flutter on Nampak. I certainly wouldn't put Granny's pension fund or my children's school fees on Nampak, but I think for those with a risk disposition, Nampak could be a very interesting proposal going forward. So now I'm going to talk about a couple of my special situations. As I said, if I keep sipping on my Energade, it's because my throat's getting dry and I do have a bit of a cough. But being British, the show must go on. And I wouldn't like to disappoint any of you who have logged in and agreed to listen to me chit-chat about the small to mid-cap market. I've got two special situations in my portfolio this year. There's Mustec, the IT hardware and services company, very well known to you. Everybody knows the Mustec brand of computer and laptop. And the second one is Assupol. Now, Assupol may not be that well known to you. It's listed on the Cape Town Stock Exchange, and it was founded in 1913 as the Assurance Society for the South African Police Force to actually give benefits, funeral policies, savings plans, etc., into the police force. Fast forward 100 years later, trading at 9.25 Rand when I selected it, the company has one of the largest market shares in the government employee benefit system. So if you own a funeral policy, a savings plan, a retirement scheme, etc., as a government employee under the per-cell scheme, Assupol is the place that you go. You may have seen that ubiquitous, very large building near Menlyn Park in Centurion/Pretoria. It's a very conservatively run company. They don't like taking risks. So why have I chosen it, given it's on the Cape Town Stock Exchange, not that liquid, and trading at 9.25 Rand? The answer is simple. As it stands right now, the stock is trading at a 45% discount to its enterprise value. What that basically means is, if you look at other listed competitor companies on the JSE, and the most ubiquitous one that you would know is Clientele Life. You see those adverts in the daytime talking about legal services, funeral policies, etc. Assupol is basically like Clientele Life, but mainly targeted towards the government sector. Now, why is that interesting to me? Because in the wider economy, without much job creation, the only sector of the economy actually creating jobs is the government. They just love spending our tax money creating jobs for anybody. And as such, Assupol has a very captive market of government employees to sell its products to. So to me, Assupol is conservatively managed, as I said, has a big discount to net asset value. And here's the clincher. A little while ago, its largest shareholder, which owned 46% of Assupol, was acquired by a very well-known investment bank, a domestic investment bank, perhaps with a zebra in the logo, as I look away. I'm led to believe that perhaps that asset in the longer term will not be core to its business, and they'll take what they want and they'll sell the rest. Now, given that the stock is trading at a vast discount to its comparative peers and a big discount to its embedded value, I can see Assipol upon any transaction probably moving to around 14 Rand a share. I've heard whispers of even 16. And I like stories like that. You've got a very resilient, solid business, over 100-year track record, nothing fundamentally wrong with the company, which might see corporate action. So Assipol for me is a very interesting scenario. Moving on to my special situation number 2, Mustek. I've covered Mustek for many a year. And I'll say up front, David Can, the founder of Mustek, and I were friends for many years. Sadly, he passed away late last year. He was the fittest man I ever knew. I mean, when I used to go to David's house, we used to do bench presses or push-ups, and he always used to win. And I shall miss his infectious laugh and his competitive spirit. But Mustek carries on regardless. The family inherited the underlying stake that the founder owned, and the company itself is a very interesting one. Despite the slowdown in the second half of last year in hardware sales, particularly in the consumer sector, because we all bought laptops and work from home PCs and printers during the pandemic, and they don't need to be replaced as often. There has been a slowdown in the consumer side. Internationally as well, there's been a chip shortage, and there's been some logistics issues in sourcing the products from the Far East, China, Taiwan, into South Africa. We all know about the cost of transporting containers from China into this country. That all had an impact on Mustek last year, and the full year results to 2022 were down around 19%. So despite being down 19% on a revenue base up 11%, the price earnings ratio of Mustek is still around 4 times. 4. Now, there aren't many companies that I know which have a strong market share, a very well-known brand, and an area of growth in terms of renewable energy, business and technology services, and ICT services trading on a PE of 4. They're also trading on a large discount to net asset value. Net asset value is about 24 Rand, round numbers, and the current share price of Mustek is 15 Rand. So I said to the company last year and the year before, why are you even listed? If the market does not appreciate this 800 million Rand company, just delist yourself. And then sadly, the founder passed away. Now, it is my belief that at some point this year, that interest will be expressed towards Mustek regarding a delisting. I think that management would really like to own part of a company. The family want to stay in, but perhaps dilute their stake so that all of their money is not in one basket. And then a private equity or another player will come in and take the residual equity balance. So as it stands right now, and I chose Mustek at 14 Rand 39, I had a target price of 18 Rand because any company being delisted is probably not going to go for net asset value, much as we'd like it, which is 24 Rand, but it certainly isn't going to go for 14 Rand 39. So I believe that 18 Rand is a fair number. I'm aware there has been an interest expressed in Mustek, and so I chose it again as a defensive, well-positioned company with a great track record, with a very well-known brand, which could, in my eyes, see corporate activity next year and the company delisted. And in any portfolio, it's always nice to have some form of speculation in the mix, albeit hopefully informed speculation. I'm now going to move on to one of my other big blue chip mid-cap stocks, which is CoOp Agri. For those of you that don't know CoOp Agri, its name is misleading. They're actually changing their name at their forthcoming AGM, which I think is the 9th of February, to KAL Group, to better reflect the fact that 88% of its business's profit comes from retail. It's not retail that you would classically know. They don't sell clothes, they don't sell shoes, they don't sell tackies or food. They do, but not like Pick n Pay, Fashini, Truworths, etc., etc. They sell the same products that you and I buy every day at the well-known retailers, but mainly in what I would call a more macro mass mart type environment. I nicknamed this company many years ago the Boer Mass Mart, purely because it's Afrikaans owned, Afrikaans run, and unlike Mass Mart, which was basically a falling down company, CoOp Agri has done exceptionally well. It's one of the very few companies listed on the JSE, which has had an unbroken a compound average growth rate for the best part of 10 to 15 years of 15% per annum. Now, you show me any company in the retail space that has consistently shown 15% growth in its underlying operations year in, year out, and trades on a price earnings ratio to my forecast of September 2023 of 6. You're not going to get one. So CoOp Agri is a hybrid of Cashbuilt, Massmart, and some other retailers. Agriculture only comprises less than 25% of the underlying business, which is why they're changing the name. In terms of the underlying silos, 25% comes from retailing fuel. They did a very large transaction in November 2021, spending R1 billion buying a nationwide chain of very large service stations on all the key roads, the N1, the N2, etc., that you travel on when you leave Joburg to go down to Durban or Cape Town. Now, everybody thought, why are they buying these fuel stations? Clearly, it's a zero-sum game. The answer is, if you understood what PEG actually is, you get the answer. Fuel, yes, it's fuel. You're filling up your car with petrol or diesel. But in these large service stations, you're stopping at the side of a road in the middle of nowhere to fill up your car, usually not at the best prices. The kids want to go to the bathroom, your wife or girlfriend or partner wants to go to the shop. You want a pie or a soft drink, etc. So much of PEG's profitability, 65% of the last set of results, comes from its convenience stores and its quick service restaurants business. They've just tied up a deal with KFC to put some KFCs on some of their sites around the country. 25% of their business then comes from, so you've got fuel, 25%, convenience stores and QSR, 25%, agriculture, 25%, and general retail via the brand Agrimart having another 25%. Now, in the last results to September last year, the company had earnings of R5.78, up 21%, and paid a dividend from memory of R1.68. See, it pays to be an engineer. We have a memory for facts and figures. Now, based on my forecast to September this year of another very good season for agriculture, the fourth we've seen in this country, I've got a forecast to September of R7 a share. And when I chose CoOp Agri at R40.97, the price earnings ratio to September was under 6. Now, interestingly, CoOp Agri started 2022 very firmly. It was up probably on a weighted volume average price basis around R48 this time last year. And then in February, nasty old PSG and Zeda came along, said it was unbundling all its assets, and the market suddenly got spooked that 42% of CoOp Agri would be hitting the market. The same with Kuro, where 64% was basically unbundled. And as such, the share price sank because all of that stock would be sloshing about the market. So Zeda initially unbundled its stock, and then PSG, which inherited a stake, unbundled their stock in September. So CoOp Agri was under the liquidity whip as everyone was deciding what this company actually is. Do we want to hold it? And what is this CoOp Agri company? So the share price languished all the way down from R50 to about 35. At about 35 to 36 Rand, I came up with another very strong buy. I've basically recommended the stock from R7.30, and it's one of the largest positions in my personal pension fund. And it's a stock that I've routinely said, I will never sell this company. That's how good I think this company actually is. And at 36 Rand, I thought the stock was basically undervalued. And once the institutions actually understood what the company is, and the presentations they would do to the large asset managers was understood, and they could understand the narrative and the growth trajectory of this company, the stock would start to re-rate. And that's exactly what's happened. I think as of this morning, CoOp Agri was trading at around R43 a share, which is not bad. So it's up year to date. So I think that CoOp Agri is going to have a very good period to March. As I said, it's a March interim period. The annual general meeting is happening in mid-February. And I think that the market is now beginning to prick its ears to this very well-performing retail company, which just happens to be in the agricultural space, but it's not in the agricultural space. I'll give you some examples here. If you go into any one of the Agrimark stores, and any of you who live near an Agrimark should clearly go into one of the large operations. The Stellenbosch store, for example, has sales per square meter that would make Vashini and Truworths blush. One of the largest products that they sell is workwear. Now, I think, well, workwear isn't very glamorous, but let's not forget that given health and safety and people working on the farms and in businesses, workwear and safety is very paramount. You don't have the government coming in and giving you a clip on the ear. So the workwear situation under the Johnson's brand is a very, very high margin, high growth business. You've then got, interestingly, another large top 5 category, apart from groceries, because everybody wants to buy groceries. You've got dog food, and I was staggered about dog food, but all of the farmers and the large small holdings near a CoOp Agri tend to have lots of dogs, and they sell hundreds of millions of rands of dog food a year at very juicy margins. And then pool and garden chemicals and equipment is also a very large market. So none of those are really agricultural related. They're things that you would pop into a Build It or a builder's warehouse or a cash vault to buy. It just happens to be a CoOp Agri. So to me, CoOp Agri at the current price remains highly attractive, and it's a stock that I would have as a core portfolio addition in any long-term mid-cap growth portfolio. So I'm just checking my list here of what I've done so far. So, okay, let me move on. I'm going to move on to another agricultural company as I take another sip. Again, listed on the Cape Town Stock Exchange, there is an agricultural business worth 2 billion rand called TWK. Its full name is the Transvaal Wattle Company, founded in 1946. And basically it produces timber and it exports wood chips into the paper and pulp market in Europe now and in the Far East, but it's also an agricultural business. It services in Mpumalanga, part of the Upper Natal region, into Swaziland, etc., etc. It has a very fast-growing financial services division, and it also sells Toyota cars and Haval. But its two biggest areas is trade, allied to the agricultural sector, and timber. Timber is the most profitable business inside TWK. In the last set of results to August 2022, excuse me, my apologies, they had earnings of R8.63, which were about 42% from memory rise year on year. That was driven by a very good set of numbers from a retail and a trade arm, the side of tractors, agricultural equipment, services to farmers, etc., etc. The timber side shot the lights out. They export timber from Richards Bay. It has a 900,000 ton capacity, and in the last set of results, they exported around 680,000 tons. And given it's a rand hedge, as they sell the wood chips in dollars, as the rand weakened, they were making very, very good money. So why am I bullish on TWK, which I selected at 52 rand a share? The stock, for one, has doubled since 2020. I chose TWK in a previous top stocks in 2020, early 2021, at 28 rand a share. And at that point, it was trading on a price earnings ratio at 5. With a huge growth in earnings that we have seen this year to R8.63, it is still trading at an abysmally low ratio. In fact, one of the lowest ratios of one of the largest agricultural companies that I currently track. It's very well managed, and they are very confident of even more aggressive growth in the forthcoming year to August 2023. Why do I say that? Because wood chips is exported. As the world has reopened, and particularly China, the demand for wood chips to go into paper and pulp and other products continues to be buoyant. So they intend to grow their footprint from 680,000 tons this year to 900,000 tons. So that's a 1/3 rise in the underlying exports and a rand hedge stock, given the rand year on year has weakened. The agricultural sector is continuing to do quite well. And at some point, CoOp Agri, it's owned by a holding company, TWK Holdings, will probably simplify its underlying share structure. It is somewhat illiquid, but there are only 38 million shares in issue. But given this stock has been one of the best performing agricultural companies on the market for the last 7 years, it's one of the stocks that nobody apart from me and a handful of people that cover my notes or read my notes knows about. You could have bought this share 5 years ago at less than 10 rand. It's now trading at 52. Now that compound growth rate in 5 years with a good rise in earnings and dividend and a low PE remains a compelling one. So I'm looking for earnings this year, probably around 10 Rand a share. So 10 Rand and a 52 Rand share price gives you a P of around 5 with a solid dividend. To me, TWK is one of these unsung heroes in the agricultural sector, which hides its light under a bushel, and purely because of its listing on the Cape Town Stock Exchange, isn't widely known to the institutional market or the private client market. So if I really had to be in any agricultural stock in the longer term, CoOp, because it's JSE listed, and TWK, because at some point it will probably move its listing to the main board of a JSE, and as a 2 billion Rand company, institutions will get involved. So to me, CoOp and TWK are great additions to any portfolio if you have any interest in agriculture. Excuse me again, new bottle. I'm taking off my list here to make sure I don't miss anything. I'm now going to talk about CoOp Holdings. Now, CoOp Holdings, for those of you that know, is the country's largest private educational system or company. It has primary schools and high schools. Now, I've been covering this company for the best part of 15 years. And for the best part of the first 10 years of its life, it shot the lights out. Listing at 4 Rand in 2011, the share price promptly reached nearly 60 Rand in 2015. And then this stratospheric rating that it had, as the domestic economy was beginning to bite the bullet, the share price, which at one point was on a 1,000 times PE, sharply derated, which was understandable because the company was just spending money left, right, and center. It had 6 rights issues and was just putting down new schools everywhere to build its nationwide network. Now, that's all very well and good, but basically it all caught up with it. By 2019, 2020, the market was getting fed up of rights issue after rights issue, of earnings disappointments, and the very fact that the company's share price had completely slumped because of the earnings misses. So I call CoOp from 2020 to the current date, the lost 3 years. During the COVID sell-off of March 2020, CoOp fell to 4.62 Rand. I chose a stock at 9 Rand, so it's had a nice rebound, but certainly not as aggressive as some of the other quality mid-caps in the sector that I cover. So why have I chosen CoOp? The answer, again, is a simple story. Everybody knows the state-owned school system is crumbling like every other state institution in this country. Many of you may have read the comments on social media about children going to state schools at the start of this year and not being able to be placed. So parents are now taking a conscious decision of where do they want their children to be educated. And inside CoOp, there are price points to suit any budget. In November last year, I took some clients to 4 of their schools in Cape Town, from one of their high-end schools in Durbanville to one of their low-fee schools in Delft, which is quite a rundown, deprived area here of Cape Town. And there you were charging fees of 1,500 Rand a month for a child to get a very decent standard of education, but there's no polo ponies, there's no ballet classes, and there's nothing fancy. You just get good quality, honest education. And speaking of the children there, the stories about families clubbing together, communities clubbing together, to put one of their brightest children through a school because they wanted that child to actually succeed and do better in life. So anyone can send their child to a fancy school if you have the money. But an interesting fact, 70% of all the learners inside a CoOp school are from previously disadvantaged backgrounds. So these are families from that demographic who have consciously decided to send their children out of the state system to a private school because they want to have better education for the children than perhaps they had in the private system. Now, what CoOp basically failed to do was to capitalize on their school footprint. They put down lots of schools, but they were basically not filling them up. So there was a capacity utilization problem, which means the cost of running the schools remained quite high. But it's the last child's bum on a seat that I was always told by the founder, Dr. Chris van der Merwe, that really makes the money inside a classroom. So in the middle of last year, management decided to rein back the expansionary phase, not go out with such an aggressive new school build policy, and start filling up the schools they already have. And that's actually happened. Interim results to June 2022 saw earnings up 40% to 27.5 cents a share. My forecast of this year to December is 53 cents. Now, 53 cents when I chose the stock at 9 Rand puts the stock in a P of 17, which is very much in line with Advotech. Now, granted, Advotech is a much better company, well-established, prodigious cash generation, and it has a tertiary and the schooling side. But my view was, as the earnings momentum in CoOp starts to accelerate, because they've pared back their capex, and the last big capex push will end at the end of 2024 into 2025. You've got a company that was spending over R1 billion a year on building new schools, reining that back into maybe 400 to 500 million rand a year of maintenance capex, freeing up cash flow, which will be used to repay debt and provide shareholders with a dividend. That, with better capacity utilization, should lead to an earnings uplift. So I believe in the next few periods from CoOp, you're going to see an earnings uplift coming that we've been waiting for years. And as the earnings hopefully start to come through, that 9 Rand share price will start to unwind the PE quite aggressively. So I've got a target price of CoOp of 16 Rand. I'm either going to be very right or I'm going to be very wrong. But interestingly, the Mouton family trusts and the Mouton family who unbundled via PSG, their 64% stake in CoOp September last year, have been quite substantial buyers of CoOp in the last couple of months. So they know the business better than anybody, because they basically bought 50% for 50 million Rand many years ago and helped fund the underlying expansion. So I'm just taking an informed, analytical view. The company has turned the corner. The travails of COVID is behind it, but underlying demand for private education remains. It's not brilliant. We're probably talking 5-6% per annum, but it's still people leaving the state system to put their children in the private system will continue. And as such, the benefits to earnings and dividends will start to accrue. So CoOp to me at 9 Rand. It hasn't performed that well year to date, but it's still only the 18th of January. At some point when the trading update comes out and the results at the end of February, I'm hoping it'll start to perk up. So I'm down to my last 3 shares. I'll take another sip. I hope I'm not boring you, and I'm hoping that my diction and the information I'm giving you is not too mind-boggling. Let me just check the time, because Pascal knows where I can ramble. Oh, it's 6:06. I'm speeding ahead. Okay, I'm now going to go on to another consumer stock, which I think is really, really interesting. Again, it's a company that was unbundled from PSG back in September last year, called CA Sales, or called CAA as a JSE ticker. I chose the stock at about 6.40 Rand, and I think now is trading at about 7 Rand a share. Now, those with long memories, and I'm not quite sure how many of you on this website will remember, there used to be a company listed on the JSE probably 12 to 15 years ago called CA. That was basically sold to Imperial for a very fat price, and the same management team thought, you know what, after the restraint is finished, we'll start another business. So CA&S, what it does is it operates in Africa, and it takes goods and services which we buy in this country for granted: Colgate toothpaste, soap, liquor products from Distell, confectionery from Nestle, chocolate bars from Cadbury, and they market them and they place them into the informal and formal retail market in the Southern African development community. We're talking Botswana, Namibia, Zimbabwe, Malawi, etc., etc., etc. And they do it extremely well. In those territories, it's all about the relationships that you have and the ability to get the product to the shelf. If it's a small quantity to a small spaza owner in the middle of nowhere, or a large ShopRite or a Choppies in Botswana. And they do this with elegance and with great profitability. When they unbundled the shares from PSG, went out in a huge repositioning of the company, and they came up with a very bold target. They want to have a 20 billion Rand revenue base within 5 years. Currently, it'll be about 10 billion Rand this year. That'll be a combination of organic growth and selective acquisitions, potentially into new territories. They are looking at expanding their distribution footprint into the old East African region of Kenya, Tanzania, Uganda, Rwanda, etc., which again is very fast growing. So to me, Africa is a consumer society. More people are leaving the countryside to go to large cities. They want all the convenience and all the consumer goods that we as a nation in this country take for granted. And consumerism and formal retail is actually beginning to expand. And I'll give you one example. C&S recently won a contract with Nestle to take its products into Namibia. Now, Nestle makes Kit Kats as an example. Now, I thought, well, that doesn't sound like a very exciting business until I found out that that contract was worth 300 million rand just for a couple of product lines into one country in Namibia, which has a tiny population. Imagine what they could do if they take the same products for their 200 international companies into other jurisdictions in Africa that they currently operate in. So the simple case for C&S is they're already sending a shopping basket into Africa. To add a few extra goods into the same shopping basket and the same truck with the same people is an incremental cost. So they will grow their base by just adding more goods and more products into that basket and marketing it wider. So C&S this year, I think will probably make 70 cents a share. Now, 70 cents when I chose the stock at 6.40 rand meant the company was trading on an abysmal P of around 9 times. I think that is clearly too cheap for a company which has a long-term track record and a near 40-year relationship base operating in Southern Africa. What's even more interesting is as the unbundling happened, I think PSG unbundled about 47% of C&S. Institutions took a look at the stock and many of the larger ones liked what they saw, which is why we didn't see too much of a sell-off post the unbundling. It was very volatile. The high of the stock was 17.50, the low was about 5 rand. But the stock settled at about 5.50 rand and institutions started buying. We're now trading at around 7 rand. I have a target of 8 rand, which doesn't seem like a lot, but you know what? I think it's probably worth 8.50. So as it stands right now, and I picked the stock at 6.40, I will take an uplift to 8.50 any day of the week with a dividend in a company which has a natural growth vector into the Southern African development community. I'm now down to my last 2 stocks. One more sippy. I'm amazed I haven't coughed yet. My last 2 stocks are 2 activist-led stocks, which have had significant runs in their share price in the last couple of years. They are York Timbers and Novus Holdings. I'll start with Novus Holdings. Novus Holdings back in the day was trading at 60 cents a share, 60. Now, it was one of those stocks that institutions didn't really care about because it was involved in the old printing and publishing sector, which was seen as a dinosaur, a dying industry. Everybody wanted to be in sexy digital media and the web and all of that wonderful technology stuff. So they left Novus alone and they printed school books for the state. They printed all of those flyers you get in the newspapers for the likes of ShopRite Checkers, Pick and Pay, all the specials, all the little flyers and inserts. And it was very unglamorous business. But unbeknown to many, Novus was cash rich. For a company which was trading at 60 cents, they had a net asset value of about 4.65 rand a share. So you could have bought this company literally at about 15% of the cash that it actually held in the business. But the institutions didn't care. It wasn't sexy, it wasn't growing, it wasn't glamorous, and they didn't care. And then an activist came in terms of A2 Investment Partners. They took an instant liking to the company because they could see the cash. They took a stake, and they now built their stake up to 53%. And they did a mandatory offer to shareholders late last year at 2.35 rand. So they now own about 53%. Now, in the last results, Novus didn't have a great period because they were locked into buying very expensive international newsprint when the international newsprint price had gone through the roof. And of course, the rand had completely collapsed in the last 12 months. So they actually saw a massive decline in their headline earnings per share. Some extra tidbits for you. I understand that the newsprint situation has been sorted out. They will be procuring a newsprint this year from domestic sources. and the horrendous earnings they had last year should start to normalize. They also did a very, very interesting strategic transaction at the tail end of last year by buying the educational assets of Pearson. Now, Pearson is an international company, very well known for publishing online and in hard copy format educational textbooks. It's one of the leaders in this country. And as we all know, if you're going to school or varsity, textbooks ain't cheap. They update every single year and you have to buy new ones. So what Novus did in an extremely elegant and very astute transaction is they bought Pearson for 800 million rand to marry the analog side and the digital side. So books can either be printed in hard copy or on the web, which means that if there's obsolescence in due course from a printing side, Pearson's digital side will pick up the slack. Pearson is also extremely profitable. So Novus last year made around round numbers, 50 cents a share. It then collapsed to the single digits, and Pearson itself will make 50 cents a share. So at some point, as Novus starts to normalize and Pearson starts to kick in, despite the debt they have, which will be repaid in the next few years, I can see a significant uplift in the underlying earnings profile of Novus. And when I chose the stock at 3.65 rand, based on my numbers, the stock was trading on a PE of between 5 and 6. Now, this is now actually a growth company because of the acquisition of Pearson. There's a recovery element from the printing and packaging side, and the company, quite frankly, has continued to deliver fairly well to shareholders. They've paid out a significant amount of cash in special dividends. There's more property sales to come and more special dividends to come to shareholders. So when I see a stock trading at 3.65 rand with growth potential, greater value unlock, and a marrying of the digital and the dinosaur side, I get quite excited, particularly on a P of 5 or 6. And at 3.65 rand, I think the stock is clearly one that I would like to have in a small cap portfolio. Sit back and just let the money start rolling in. My last stock and my last sip, hopefully, is York Timbers. Now, I've covered York Timbers for many, many, many years. Back in the day, it was run by a guy called Solly Tucker, and York was predominantly known, apart from its forests, for all the York timber products you could find in a supermarket: clothes pegs, ironing boards, washing racks, etc., etc. But sadly, over 10 years ago, new management were installed, and they decided that they would start remunerating themselves based on net asset value rather than earnings and dividends. So all they did for over 10 years was grow this company's net asset value. It is currently about 9.50 rand, and they didn't really care about profits or earnings or dividends. And so the share price basically stagnated. The private equity partner involved, Metier, basically bailed out about a year and a half ago, and they sold their stake again to A2 Investment Partners for less than R1, which gave them around a 17% stake. And as it stands today, that stake is now about 31% following a recent rights issue, which I'll come to just now. So inherently, timber is a long-term game. Now, they say that money doesn't grow on trees, but actually it does. Once a tree has reached a certain maturity, you can harvest it, strip it, and sell it. What York had been doing for many years, because of its poorly performing structures, was harvesting its trees at a much earlier age than it should, at around 17 to 18 years. So they were getting cash flow, but they weren't maximizing the value for the log. So what basically happened is the activists saw this. They decided to come in and take a large stake. They restructured the board and appointed the former CFO as a new CEO following the untimely passing of a former CEO. And earnings rebounded quite sharply as efficiencies and operational productivity kicked in to York. Then sadly, last year, as the recovery tack was occurring, there was exceptionally wet weather in the north of the country, which meant harvesting logs was very difficult to get into the forestry areas. And then NUMSA had an extremely violent 3-month strike at one of their key sawmills, which caused earnings to collapse in York for the 2022 period. But the net asset value stayed reasonably high. So the current activist shareholders, A2, decided that in order to benefit shareholders in the longer run, if they were to lengthen the age of a log from 17 years to up to 22 years, yes, they'd have a short to medium term impact to EBITDA and profitability, but an older log sells for significantly more than a younger log. And I'm going to give you a direct example. If you sell a log at 17 years, you get X price. For every extra year you let that tree grow, the timber hardens, the log of a tree actually grows in width. It adds between 10 and 15% in value to that log for every 1 year it's left planted in the ground. So after 5 years, you've basically doubled the value of the log compared to harvesting it at 17 years. And it's cost you nothing. It's just cost you time. So yes, there's a time value of money. And yes, York will have to supply or source more logs from other players in the medium term. But in the longer term, I envisage management to completely overhaul the manufacturing and plywood division to improve the underlying capacity utilization and efficiencies of their sawmills and their plywood business. And as the logs mature and they are harvested older and more valuable, that should start to flow to shareholders in terms of better earnings and, for the first time, hopefully, in over 12 years, dividends. But this is a work in progress. The activists have only been involved for less than 2 years. Everything was going well, and then the wheels fell off the bus because of the strike. I now understand it's getting back to where it used to be. Demand for timber remains robust, a bit like the TWK story. And as the state-owned forestry company, Safcol, again, a typical state company, falls off the tree, is basically harvesting more than it plants. At some point in the years to come, privately owned timber companies like TWK and York will be extremely well positioned because the state will be unable to supply the amount of logs needed in this country for the mining, construction, and the export market. So I believe at York as a value play and a value unlock play. When I chose it at R2.02, I think today it was trading at R2.50, remains a very compelling argument. So those, ladies and gentlemen, are my top 9 stocks. They were Nampak, York, Novus, CoOp Holdings, Mustec, CoOp Agri, Astral, TWK, and CANS. I'm hoping that that combination of fairly resilient stocks fares me well for this year. I think this year on the JSE, we are going to have a very volatile period because of the economy, because of electricity. And of course, let's not forget that in 2024, we have a national election coming up. And we all know that in the electioneering phase, which will probably start September, October, November this year, government basically grinds to a halt. They're too busy trying to get their jobs protected and re-elected to care about the economy. And I think the country this year will start to stymie, and you'll have to be very selective of your stock situations. So that's why I've selected a basket of stocks that I think have a combination of good growth, solid fundamentals, some special situations, and more importantly, you can sleep at night. But I had to put in a wild card because a wild card would not be me if it's not me. Otherwise, let me have a look at the questions. There's one here. How do I buy a share on the Cape Town Stock Exchange? From an anonymous attendee. If you go into the Cape Town Stock Exchange website, CTSE, they have their own trading platform called A-Trade, and it's very quick and easy to open up an electronic digital account to actually trade in these shares. So have a look at the Cape Town Stock Exchange website. It is all very straightforward once you do the FICA paperwork. A question here from EJ. What is the influence of Transnet failure to transport goods for export to Richards Bay on earnings expectations on the shares mentioned? Well, in many cases, most companies, as you know, actually now bypass Transnet. They either truck the things down or Transnet actually still works. I'll give you an example. I was actually at the Grindrod operation in Richards Bay in a site visit at the end of November. And it takes about 48 hours. Sorry, it takes between 48 and 72 hours to get a train from a reef down to Richards Bay, where you can truck the same product in 24 hours, even though it's more costly. So it's the inefficiencies of Transnet that actually, hinder business. But something like coal and wood chips can just be exported, you can just pile up on the docks and be loaded. So I'm not that concerned regarding certain commodities for export. TWK have their own export facility at Richards Bay. It handles 900,000 tons a year, and their own logistics capacity at that point of departure. So I'm not too concerned. As a matter of interest, in the last 2 years, their volumes have gone from about 340,000 tons to 660,000 tons and should go to about 900,000 tons this year. And in a recent conversation I had with the company during its AGM, they intend in the next round of their CapEx requirements to expand about 900,000 tons north of 1 million tons because of the international demand. So in certain commodities, particularly foodstuffs, fruits, et cetera, which is perishable, I do get concerned about Transnet. Hard commodities isn't going to go off. It does take longer and it is more expensive to actually export, but you can get it to the port. So that's my scenario on that. Let me scroll down. Okay, there's a comment here about A2 Investments from Mark Atkinson and their interest in York, Novus, and Nampak. They do have a limited social presence. It's actually a privately owned company backed by high net worth individuals. They keep their light under a bushel. So it's very difficult to follow what they do. I've written about the companies in Financial Mail articles and in my own normal institutional writings. The two founding partners is Adrian Zettler, who was formerly a fund manager at Coronation, and Andre van der Veen, who is very well known in the corporate sector, having worked in a number of HCI companies, turning around some pretty dire companies in that portfolio. So he has a very good understanding of knowing how to turn a company around to make it profitable. So between the combination of the two gentlemen being able to spot value and engender operational and managerial change in companies, they've done extremely well for themselves and, of course, for the shareholders that have gone into the ride. So Nampak is their latest, and I'm hoping that the current work they're doing with Nampak will play out and be the next winner for shareholders. Target for York, £3 a share. Let me double check. Yes, £3 a share. I chose it at £2.02. Target is £3. I've already mentioned Renergen in the opening preamble. I'm looking here at other comments. York is up 8% today. Any idea why? Well, again, from what I've told you about the potential for that company. Some other non-related questions to my presentation. What do you think about Astral Foods Limited? I published a note yesterday with an opinion that I'm anticipating a catastrophic trading update to March coming out from Astral Foods. You may have seen a MoneyWeb article on the impact of load shedding. There's also an article on the 10th of January in the Business Day. And I think they are softening the market up for what could be a truly awful trading update and set of results, possibly moving the company into a fat loss. At 153 Rand, what I saw it up this morning, Astral is a superbly run company. I can't fault management. They are probably one of the best farmers of poultry in this country, if not in one of the top 10 in the world. But sadly, due to impacts above and beyond their control, load shedding, a lack of water, high input costs in terms of soya and maize, they, alongside every other poultry company, have been affected by outside factors which they couldn't control. Because you can't suddenly push through a huge price increase in chicken because the maize price is up 20%, or the electricity price is going up, or having to pay for generators, because the embattled consumer currently, who sees protein or chicken as an affordable type of protein, won't afford it, or can't afford it. So there's been margin compression inside Astral Foods. And I'm forecasting this year they could make a loss. At best, they'll probably make 5% if the stars align we get proper electricity. And if the maize price falls to about 3,500 to 4,000 rand a ton, currently maize is trading at about 4,445 a ton. So Astral and the poultry and egg sector currently are companies I do not want to be in. And I would wait for trading updates and then see what the underlying narrative is. Bear with me. I'm just scrolling down to see what else may be of interest. Excuse me, I've got to take another little sippy. There's a couple of questions on Omnia. It's been a favorite stock of mine. I had a buy my stock in July 2020 at 27 Rand 30. It made all of my targets, 50 Rand, 60 Rand, and 80 Rand. It's now back in the 60s. And I'm actually meeting with management in Johannesburg next Tuesday. So it would be remiss of me to actually give an opinion right now until I actually have spoken to management. I think they're going to have a very, very good results period to March. They had a very robust first half, and in a normalization of their trends, the first half should be 40% of earnings, the second half should be 60%. So I'm forecasting another very good set of results from Omnia, and again, another very good dividend. So the share price has been under pressure, purely because the market doesn't understand the fertilizer market in this country. They're just looking at the international fertilizer market and trying to impute what's going on in America and Europe into this country. This country is different. We have supply chain issues. We can't import that stuff. It's expensive to import. And, with problems at Sasol, having an inability to supply ammonia, Omnia has its own production of ammonia and it's been trucking the stuff in from a Durban port, having secured it internationally. So Omnia was one of the very few companies this year to actually have plentiful stocks of fertilizer to meet what could be another very good agricultural season. So I have no qualms about owning Omnia. I think I need to understand what the future will bring into 2023, 2024. As it stands right now, I'm forecasting very good results to March and another very good dividend. And it's a fairly defensive play. And I think there's more value to be unlocked from that company. What's your take on Purple Group? Don't cover it. Don't do financial services. There's another one in Omnia. I don't cover Ultron. I'm flicking through here what is of possible interest to all of you. As a comment on Stadio, again, for those of you that follow me on social media, I had a large piece on Stadio, Advatech, and Coro last year in Financial Mail, and I stated categorically, if I only had to own one stock in a portfolio for the longer term in private education, it would be Stadio. That stock was priced at 3.62 Rand. It promptly went to 5 Rand. It's a truly amazing company. It doesn't need much capital. And there's a natural growth vector for students looking to upskill their level of qualifications, either for jobs in this country to try and secure jobs or career promotion, or even to leave the country and try and get jobs offshore. So if I had to be in only one stock in education, it would be Stadio. But my medium-term pick is Coro, because I believe the earnings uplift in the next 12 to 18 months will see the PE ratio come down. I now see I'm at 6:30, and Pascal will probably shout at me. So I'm going to pause from here and see if Pascal's coming back online. I hope you genuinely enjoyed the information I've given you on my top 9. I hope the level of detail and information was of interest and was illuminating. And hopefully, let's cross fingers that my top 9 this year will once again outperform the market and we can all make some good money. Some of them have done quite well year to date. Nampak up 27%, York up 24%, amongst others. But part of a rule of my competition with myself is I can't chop and change. I have to hold these stocks for 12 months, despite any changes in the underlying nature of the company. So they're in for 12 months. So I will be keeping a regular eye on their performance, and then updating on a quarterly basis how the top 9 is doing. From me, Anthony Clark, and my dog Yarpy, who's sleeping at my feet, thank you so much for listening into this webinar. Thank you again to Rand Swiss and all the team there for the sterling work that they do. To Pascal and to Gary, thank you. And I'm hoping that my coughing and my sipping of my Energade wasn't too distracting. Thank you once again and take care.